While current market movements may appear different from the past, there are nevertheless lessons to be learned from what went before. With us now is Jonathan Wilmot, Credit Suisse's Chief Global Strategist. What lessons can we learn from past crises and use to navigate today's environment?
Well, there are many lessons you can learn from history if you read carefully enough. I think we're headed for a repeat of the kind of great reflation that we saw at the end of the 19th century after a couple of big banking crises.
How can investors best prepare for that?
In the great reflation, the big lesson is that returns will be very low for bonds. Real returns will be adjacent to zero, perhaps a bit below, perhaps a bit above. The question is, what's going to happen with equities? First point is that equity returns will be higher. The second point is that we don't know yet just how much higher. But in that period that I was referring to, then there was a period in which real equity returns in the United States were considerably above their long-term trend of 6% per annum greater than inflation. So to talk about 6, 7, 8% real returns is not impossible, even with very low real bond returns. Indeed, it will require bond yields to stay low to get such returns from equities. The problem for investors is that they are now overweight fixed income. So they're already starting from behind. So clearly, greater allocation to equities, but it's going to be a volatile period. And lower volatility returns, better stock picking, I think market timing. I have a particular solution to the market timing problem. These are all going to be components of the investment environment of the future if we're going to survive low real interest rates.
What is your solution to the market timing problem?
It's basically a robot. I've designed a system for doing market timing using our risk appetite measures, which is designed to compensate for the human emotion that goes into market timing decisions. Everybody wants to buy low and sell high. Everybody, in fact, tends to do the opposite. If you program something systematic carefully enough, you can basically force people via the systematic model to buy when people are in panic and to sell when people are euphoric. And although there's quite a lot more to it than that, what we basically do is we use a systematic approach to compensate for human emotion, the biases of overconfidence, of herding, of sort of loss aversion that behavioral psychologists talk about. So we have a product which essentially does that and switches between bonds and equities to do that.
So your robot is based on behavioral finance? Essentially,
and it's also, for that matter, based on my experience of working with the smartest investors and traders in the world for the last 35 years. I noticed that they are the individuals that best control their emotions during times of stress, and I've tried to design that into the model.
So how can investors best time risk-on versus risk-off investment strategies?
I don't think that there is a case for most investors trying to be overly geared towards risk-on and risk-off. I think for large institutional investors with longer-term time horizons, that's more a question of gradually changing one's asset allocation, taking on more equity risk, taking it on in more sensible ways. And for example, the market timing system that I alluded to, which we call our Rye-Holt model, is designed to allow a certain amount of market timing so that at the margin but it doesn't do risk on and risk off every 3 months or 6 months. That's something for shorter term traders. For longer term investors, it's really a question of designing a gradual shift in the composition of one's portfolio to incorporate lower volatility forms of accessing equity returns. That's the simple message.
Thanks a lot, Jonathan.
Thank you.
For the latest updates from the Asian Investment Conference, check out the website.